This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm Financial Standard journalist Andrew McKean, here with Fidelity International cross-asset specialist Lukasz de Pourbaix. Welcome, Lukasz.
Thanks for having me.
Today we're looking at a bit of a general outlook for Asia as well as some Chinese and Indian specific questions specifically. But look, if we start broadly, what's your kind of current outlook for Asian markets and what factors do you believe will play the most significant role in shaping performance over the next couple of years?
Yeah, so look, Asian markets have been quite interesting over the last sort of 12 months or so. If you sort of reflect on broader markets, in developed markets, everyone sort of talks about the Mag 7. Within the context of the Asian market, you've had a sort of similar trend. You've had a relatively concentrated market in terms of what's done really well. So you could arguably say it's been sort of the Mag 2. You've had companies like TSMC, the big sort of chip maker. You've had companies like Tencent, for example, really do really well. And other parts of the market have really lagged, notably things like Chinese consumer stocks. So you've had a market that's been very divergent in terms of what's worked and what hasn't. And that's even been on a regional basis as well. So if you sort of look at the market and you take the sort of two big parts of the market, for example, India and China, they've had very different journeys over the last 12 months and very different outcomes in terms of performance. So in terms of what we think ahead, I think it's definitely going to be probably more of the same, a lot more divergence, a lot more volatility. So what that practically means is you really need to be prudent in terms of really trying to identify the opportunities, stock by stock in that type of market environment.
Well, let's start with China then, and maybe start with that, and kind of what are some of the kind of factors driving market performance in China at the moment, and how that might be influencing investor sentiment.
Yeah, look, it's been the topic of the day, I guess, China, and if you sort of reflect and cast your mind back to that COVID period, one of the things that many investors were anticipating was that as China reopened from those COVID lockdowns, that basically the Chinese consumer would come out guns blazing, spending, and it would be back to the races. Now, that didn't happen, and it didn't happen for a couple of reasons. One is you had a significant pullback in the Chinese property market. Many of your audience will probably be familiar with things like Evergrande, for example. So some of these big property developers are basically failing. And then secondly, on the policy front, households were sort of waiting to see, well, what's going to be the government's response? Is there going to be some kind of big stimulus package? Is there going to be, for example, this sort of helicopter money coming in and rescuing the property market, which hasn't happened, which hasn't eventuated. So you've got a consumer that is cashed up. They've actually got really high levels of savings relative to other parts of the globe, but they're not spending because there's a lack of confidence. And that has really impacted markets. And you did see a big sort of capital outflow from China, from big international investors as well. And one of the interesting things is if I sort of reflect, over the last sort of 12, 18 months, conversations with clients have been quite interesting in that probably 18 months ago, there was a lot of talk about is China investable at all? Should I have any allocation to China? The narrative has probably shifted a little bit. And I think where the conversation is at the moment is more akin to, has China bottomed down? Is it time to look at China, or is there still more pain to come? So that's how I would sort of characterize China. I think we can go into it a little bit more detail, but certainly, on the policy front, I would sort of argue that it's been a far more measured, steady reaction from the government and policymakers in China with respect to sort of trying to stabilize the economy, which hasn't had the impact maybe that they've wanted, but it's been far more of a controlled approach in terms of policy than maybe in previous times.
So, what from a policy perspective would you want to see from the Chinese government that you think would give consumers the confidence to spend?
It's sort of interesting. It's probably less what I'd want to see. I mean, I think if you sort of think about maybe the consumer in China wants to see, maybe what's happened in the past, i.e., the government just really comes in hard and throws a lot of money in the property market. Now, that's a double-edged sword, right? Because you can do that, but you might actually just create the same issues going forward. So the government has been a lot more, I guess, cautious in their approach. So what some of the things they have done, for example, I mean, we've seen cuts in interest rates, short-term and medium-term interest rates. You've had a very targeted approach to stimulus in terms of where the government's been focusing in terms of some of that stimulus. So, for example, there's been a targeted approach in terms of investing in some of the technology parts of the economy and so forth. So it's sort of been far more diversified and far more targeted in terms of the stimulus. So what does that mean? It probably means that it will just take longer to see some of those policy initiatives, the results in terms of, and then for consumers to get confidence in that. And so, yeah, it's this double-edged sword between sort of just throwing the quick kitchen sink at the economy, but at the same time not trying to sort of recreate issues of the past.
I guess demographics is definitely a big part of the Chinese equation as well. How do you kind of see that, their demographic changes? They've got, I think it's 30 something million new middle class consumers this year, but they also at the same time have an aging population. How do you think these conflating forces are going to kind of impact your outlook, and what are you kind of looking for in between the weeds?
Yeah, look, absolutely. I mean, I think longer term, if you think about the demographic outlook, that is a challenge. It is certainly an aging population. I mean, you've seen the government sort of loosen some of the rules around the one-child policy, for example, within China. So it's definitely an issue. I mean, if you compare, say, China to the likes of India, it's almost the other side of the coin. So you've got China with a very much aging demographic, and India with a very young demographic. So longer term, I mean, I think it's certainly not an immediate issue, but certainly we think over the longer term that demographic dynamic is going to be more challenging in terms of growth longer term. How they address that, look, it's going to be hard to sort of tell at this point in time, but it's certainly something that will become a bigger issue as time goes on, no doubt.
I guess in a way then the crux issue is whether or not valuations are extremely cheap across lots of different sectors in Chinese markets at the moment. Do you think it's an appropriate time for investors to start deploying selectively? I think obviously an active approach in this market's really important. Would you care to elaborate?
Yeah, look, valuation is always an interesting one because, I mean, certainly what I know in my time is that, valuation is definitely a useful tool over the long term. But over the short and medium term, we know that assets can remain cheap for a long time, or they can remain expensive for a long time. So trying to time these things can be quite difficult. I mean, certainly what we're sort of seeing at the moment is, you're seeing overall sort of price to earnings for the Chinese market in single digit level. And if you sort of then drill down a little bit further on a company level, there's even, some companies are trading at really low multiples. Now, some of them are trading for that at that multiple for a reason. So I think the biggest challenge is, just investing because something's cheap. And that obviously, the risk with that is that you can get into a sort of a value trap. Basically, you're investing in a company that's cheap, and it's cheap for a reason because it's got issues. What we're sort of seeing at the moment and is that there are some companies that are actually quality companies. So if you look at the sort of balance sheets of some of these companies, the overall earnings profile, the management teams, some of the companies are actually quite reasonable. They're trading at depressed levels. And so the big question mark then is, at what point do you see that value coming to fruition? I mean, one of the things that's interesting to sort of observe is that, if you sort of think about a market like China where it has sold off quite aggressively, and it sold off indiscriminately. So there was no sort of, I guess, safe haven, so to speak. So in that environment, it sort of reminds me a little bit of the global financial crisis, where you had all financial stocks sell off, the good, the bad, and the ugly. And then it is really a matter of sort of sifting through the individual stocks and companies. And that's what we're sort of doing at the moment in terms of China. And you only need a little bit of an improvement in sentiment. You don't need a full recovery. You only need, I guess, evidence of some improvement. And you could see some of these individual companies do really well. So I guess in summation with China, I mean, I think it's definitely, you would expect me to say this coming from an active management shop, but it is very much a stock picker's environment. Where you see a market where you see a lot of divergence, a lot more volatility, I'd argue that it's probably not a market where you just want to take the broad market exposure and just play the beta, because there are risks. And you really want to pick the eyes out. And probably the other final thing I'd probably mention is that also in terms of your return on investment expectations for investing in China should be higher, because there are more risks. So it's certainly not smooth sailing. There are opportunities, but it's not going to be for the faint-hearted, so to speak.
I guess if we could kind of dig into some of those sorts of risks, what are the sort of key traps, I guess, from an active management perspective are you, keenly aware of?
Look, I mean, I guess there's always that, it's reassessing your thesis when you've got a broader issue. So, if you think about, say, some of these consumer stocks in China, I mean, basically a lot of the consumer stocks have been quite depressed. To my earlier point, households are holding on to their money. They are spending, but they tend to be spending on lower cost items, so things like sneakers, shoes, so forth. The bigger ticket items they're sort of holding off on. So the question is, I guess, how long this environment sort of maintains in terms of this sort of depressed sentiment. I guess probably what a possible scenario would be if China sort of ends up in the sort of deflationary sort of Japanese style scenario, and that could be problematic, right? That in terms of some of those longer term, in terms of some of those consumer names, for example. So while we are obviously very much focused on the bottom up, we are aware of some of the broader issues involved as well.
Being focused on the bottom up, though, do you have any exclusions, like whether it be sectoral or whether or not it's a state-owned corporation?
No, not specifically. We can more broad. We, depending on the portfolio, we can look at some state-owned enterprises. I mean, you've seen, certainly if you look at the property market, it's been interesting when you've seen sort of the dynamics there, and you have seen some of the state-owned enterprises come in and effectively take over the sort of the books of some of the sort of private companies that have effectively gone bankrupt. So we don't have any sort of I guess hard exclusions on that. But obviously, with any of these, and I'd say, I mean, arguably investing in any sort of, Asian market, and more notably emerging markets in general, you've got to be just aware of, some of these governance issues, and each country will have their own nuances, I guess.
Yeah, absolutely. Look, if I can pivot a little bit now over to India, very, very different story there. And look, I'll start the same way what I asked you with China, and that's what's kind of driving market performance at the moment. It's been quite strong, and and how sustainable do you think that current growth trajectory is?
Yeah, so India's been a bit of a poster child in terms of markets, and there's been a couple of things I guess at play there. So you did see a little bit of a rotation away from China to India in terms of some of the institutional investors, for example. So certainly that is one point. But I guess if you reflect on the market over the last sort of 12 months or so, it's been a very retail driven market. So your average punt on the street has been investing. You've seen small caps in particular in the Indian market trade quite aggressively and perform really well relative to large caps. You've had certain sectors, things like utilities, for example, do really well. So it's been a hot market. I mean, performance has been good, but whenever you get a hot market, there is always an element of caution particularly when you've had a lot of sort of retail investors driving those markets up, notably in some of those small cap stocks. So if you look at valuations on the broad market in terms of India, obviously they're sort of, if you look at price to earnings, you're sort of trading above the 20 odd mark. So certainly not cheap. And that is one of the challenges going forward, is we have had a very sort of momentum-driven market, a very hot market. How sustainable is that? So while we like India structurally, we like the demographic story, we like the growing middle class story, all of those sort of big picture things, from a bottom-up perspective, it's really sort of looking at, well, maybe some of these, maybe there's parts of the market that have been are looking a little bit hot, so to speak, in terms of valuations, so we've been probably looking at, again, in a different way to the Chinese market, but very much trying to pick the eyes out of the Indian market and really focused on maybe some of those that part of the market that maybe has been a little bit more boring. So things like financials, for example, that haven't had that big rally, but are quality businesses and are trading at, I guess, relatively better valuations in our mind compared to some of those stocks that have gone really hard.
Is that across the board in India as well, that you think valuations might have, they're getting up there, or is there certain sectors, do you think, like you were saying, financials that are, they're a bit more boring, I guess?
Yeah, financials is, look, on aggregate level, I mean, I guess the market, Indian market, if you sort of compare it to the Asian, different Asian countries, India is looking the most expensive, no doubt about it. So just on pure valuations. But as I said before, valuations are one indicator. So things can continue to trade at elevated levels. It's not to say that, suddenly you get this mean reversion story. But I guess it's more than thinking about, what's driven by fundamentals. So what's driven by, actual company earnings, growth prospects, so forth, and what's sort of driven just by hot money going into stocks. And probably where we would sort of say is we want to focus on those parts of the market that, it's driven by fundamentals rather than just momentum. And so things like financials, so a company like HDFC Bank, which is, India's largest privately owned bank, is trading at much lower multiples than the broader market. And we do see longer term the prospects of growth and greater penetration into the Indian market by HDFC Bank to be a good long term story. So again, it's picking the eyes out of some of these markets. And look, time will tell. But typically in any market where you've got a lot of hot money, you probably just want to be cautious around just sort of following that type of money.
So earlier you said that, there's been a little bit of institutional flows that have perhaps gone from China and into India. Would you see perhaps that direction reversing, or perhaps going somewhere else in emerging markets, that is?
Look, quite possibly. I mean, you have seen other parts of the market, in Asia, obviously, you've got, South Korea is a notable market. You've got other parts of the market which are looking interesting. There's some individual sort of positions in countries like Indonesia, in Thailand. I mean, I think one of the broader challenges is liquidity. So the depth of some of these markets. So while some of these other markets, smaller markets, certainly have interesting characteristics and interesting dynamics, it's how do you get exposure to those markets, particularly depth and breadth of the market is problematic in some of those parts of the market. So we are investing in a broad range of stocks across Asia, but yeah, you've got to just be conscious of some of those other factors in terms of when investing in some of these stocks. So Korea is a good one. We've had some exposure in companies like Samsung, for example, and that's been more of a play in terms of memory. Their memory business, in terms of what they're doing in that space. So there are definitely opportunities in other parts of the market.
I guess just in closing then, if you had a headline takeaway message between China and India, the two markets, what would that be?
I'll sort of say China, tread with caution, but use your bullets wisely. So pick your sort of opportunities one by one, and noting that there are risks. And in India, it's sort of really around, caution around those hot parts of the market. And again, in a similar way, so in both markets, pick your battles, but for different reasons.
Fantastic. Well, thank you so much for coming on the podcast, Lucas.
No problem. Thanks for having me.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.